And welcome everyone. I know it's been a very long day of great presentations and all of that, and we've got a really great speaker coming up as well. Taylor Thoen, you've been a part of business television since almost the very, very beginning, if not the beginning. I've watched so much of your content. I know I've been doing interviews for a while. The amount of companies that have come through and you've worked with is incredible. And today you're going to be talking with all of our investors really about what is that you do, going over some tips for investors. And then we're bringing on Ryan Irvine, who you're going to go back and forth with him. I'm really excited about that because I've watched something prior where you guys have a lot of good banter going back and forth. And for any investor who may be new to the space, or maybe you're just a newer investor, you're going to learn a lot today as well. So I don't want to go into your time, Taylor. I want to be able to hear everything you have to say. So I'm going to turn the mic and camera over to yourself.
Wonderful. Well, thank you so much. And I hope you guys are having a good day so far. I've been doing this for a long time. I actually founded BTV, so I've been doing it since the beginning, and figured that I've probably interviewed, well, a few thousand CEOs in that period of time. So I'm getting the hang of it by now. For those of you that aren't familiar with the show's BTV-Business television. It's a show that I host and created and sold, licensed to Global TV in Canada. And since then, now it broadcasts nationally on Bloomberg, BNN Bloomberg, or Bloomberg Canada, and the Business Network across the United States. It's on Air Canada. It's on a bunch of online stations as well. And it's been on the air for 22 years. So in that period of time, I've heard a lot of good stories. We cover all sectors on the show, but today I'm going to focus on some mining ones. So having interviewed a lot of analysts as well as the CEOs, I've just learned many things. And, a lot of it feels oftentimes like the same message, just told by different people. So I don't want to sound like a repeat of what some of the things that you've heard of, that you may have heard today. And I know I've got the last spot of the day, so I need to keep it going. So one of the things I do want to share with you is a message that I've heard repeated often, which is betting on the jockey. So if that CEO, or if the CEO, if he or she has a successful track record, I know it sounds simple, but the odds are that they're probably going to repeat that. And so I'm going to share some clips throughout my talk today to keep you guys awake. And here's one from one of my favorite analysts. I'll roll off the top. His name is Barry Allen, and it's just a little excerpt here.
You're watching BTV.
If you think all the value of a gold company lies beneath the ground, mining analyst Barry Allen suggests you think a little differently.
You still, at the end of the day, to have a good company, you need management and property, but the property comes second to management.
So, we're going to sort of toggle back and forth between, but the property comes second to management. And that's sort of the theme here today for me is, because sometimes you'll have the very best asset, but it'll be run poorly and it won't go anywhere. So on that note, I have a few case studies and videos that I'll sort of toggle back and forth with you. And the first example is of betting on the jockey with a CEO who made the colossal Fruta del Norte gold discovery back in 2006. Now, this company, or that discovery was in a company, and it was subsequently bought by Kinross Gold for $1.2 billion in 2008. So Keith Barron, who was the CEO, he went on to run a few other successful mining companies. His latest is Arania Resources, and it was featured on BTV recently. So I'll roll a little clip of had them on BNN Bloomberg.
This is a BTV
News Alert.
Our flagship project is called the Lost Cities Project. It's in Ecuador near the border with Peru. Very, very large land package, 2,000 square kilometers. My previous success story was with a company that I founded in 2001 called Aurelian Resources. And Aurelian found a 13 million ounce gold deposit. We've been chasing down a couple of lost settlements mining gold back around 1600. We've got very, very good evidence now of one of them. We found what are called water conduits or water canals that have been dug into the rock, physically into the rock, certainly by the Spaniards for the purposes of washing gold. So we're in the right ballpark. We're following this up where we have geos in the field right now, and we expect some very good news shortly.
All right. So, I mean, if this was just anyone, the story might be average, right? But it's not just anyone. This is a fellow that discovered this enormous gold project back in the day. And so, you know, I'm more inclined to listen and feel a little bit more confident with my investment just because this fellow has done this all before. This next gentleman I first interviewed back in about 2010 when he was the president of a gold producer called Timmins Gold. I even found an old clip, and you might recognize this fellow because I know he presented just before me. And here's an old clip from when he was at Timmins Gold.
The mine has been cash flow positive since day one. That is a very important accomplishment. Exploration-wise, we drilled close to 50,000 meters in those 6 months. We've already compiled the information, and we have prepared a new mine plan which extends the life of the mine.
So although he was 10 years younger there, let's fast forward to 2020. He's now the CEO of Mexico's newest gold producer, Magna Gold. And that was on, I know, just before me or earlier today. We recently featured Magna on BTV, on BNN Bloomberg. The interesting thing here is, and you might have caught that from his presentation, that their main asset is the same mine, the San Francisco mine, when he worked at Timmins and he was the president in Mexico there. So here's a snippet from that.
Which is why the San Francisco mine, a past producer located in Sonora, Mexico, was such a perfect match. It was acquired by Magna Gold in May 2020.
We bought the asset at a very good price, and we are turning it around without any external money. The mission here is to generate and unlock the tremendous value in the property with our own sources, which we are successfully doing.
They're getting a lot of airtime because I think they aired that clip right after his presentation. So follow the jockey. This next CEO also has a very interesting background. He's the former CEO of Miramar Mining, which was acquired in 2007 by Newmont for $1.5 billion. So I'm leaning in. I want to know where he landed. Here's a clip with his latest venture, which is called Lion One.
Let's go find the root feeder for the system.
The hunt was on, 4 rigs drilling 24 hours a day. Then, late last year, analysis of core samples from deep within hole number 493 revealed very high-grade material, around 40 grams per ton, over 4 or 5 meters. An excellent result until hole 500.
Hole 500 went through, I'll get this right, even I can't believe it, 53 grams, 55.43 grams over 12.7 meters.
Do I think we're onto a feeder? Yes, but is it the feeder? Is it the principal feeder? I can't say that quite yet. If you'll use the analogy that this is a tree, previously Lion One has been focused on the upper branches of the tree, if you will, and now we're starting to see the system come together at depth, and we've found what I'll call is a significant branch. It's not the trunk yet, but this is a great indication, great outcome that we have a very high-grade system at depth.
I mean, seriously, I should have bought their stock when they were first on BTV. We first introduced them, they were about 60 cents about a year and a half ago, and now they're more than triple that, so or around triple that, I think, today. I hope you guys are enjoying these excerpts so far. This next example is with a CEO, Tim Warman. He's the former president of Dalranian Resources, which developed a significant gold project in Northern Ireland. Dalranian was subsequently sold for just over $500 million to Orion in 2015. I want to know, where did he land? He's heading up a company called Fiore Gold, and here's a quick clip on what's happening there.
You're watching BTV.
Though you may already know that if Nevada was a country, it would be the world's 4th largest gold producer. You may not be familiar with Fiore Gold, a Nevada gold producer of approximately 50,000 ounces per year that's aiming to grow into a mid-tier producer. We asked CEO Tim Warman to walk us through the company's long-term plan.
We're all about growth right now. Our first asset, the Pan Mine, is operating well, and that's giving us the firepower and the financial capability to develop our second project, Gold Rock, which is right next door, and then continue to grow through some strategic M&A.
M&A, or mergers and acquisitions, is in the company's DNA. Fiore Gold is the combination of an exploration company and the assets of bankrupt Midway Gold.
We bought the assets in 2016 for $5 million, merged the two companies in September 2017 to go public and create Fiore Gold. So we bought essentially a $100 million asset for $5 million and set about turning it around.
That's pretty impressive. I mean, I remember featuring Midway Gold years before, and I mean, it was a great asset, just obviously poorly run. Tim Warman picked it up for $5 million. I mean, that's value all day long. So that's another thing that I want to talk about today. I look for smart people and betting on the jockey, but also good value. So this next jockey has more than 35 years of mining experience, spent mostly in Canada's Northern Territories. Previously, he was president and CEO of Western Celtic Mines, which was bought by Sherwood Copper. And I remember interviewing him when he first took the helm of Victoria Gold around 2010, when he stated there publicly that he wanted to put this company, this gold mine, into production. I mean, it wasn't anything. There was fields there, there was forest there, and here's a clip 10 years later of him doing exactly that. It's so impressive.
This is a BTV News Alert.
The Eagle Mine achieved commercial production July 1st. Now we're fine-tuning the operation and ramping up to full production near the end of the year, producing over 200,000 ounces per year. We were able to make a $10 million early repayment of the debt in the first half of July. But in 2021, as the ounces come up and costs come down, we'll be close to the $800 per ounce cost. Just to put the numbers in perspective, with gold hovering between $1,900 and $2,000 per ounce, that's more than $1,000 per ounce margin. Times 200,000, this little company will be cash flowing over $200 million per year.
Pretty exciting. Hang on, let me just click my camera back. I see that you can't hear me when that's rolling. That's fine. I mean, those are amazing numbers. $1,000 per ounce margin. That's large profits for shareholders. The next is a standout good value story for me as well. It's definitely a quick little excerpt of buying an asset on sale. And I notice I'm wearing the same jacket as I am in the intro of this one. Here we go.
You're watching BTV.
Some of you may remember when we last featured Champion Iron about a year ago. In 2016, they sprung into action, buying the bankrupt Bloom Lake Mine in Quebec for under $10 million, an asset that had received nearly $4 billion in investments by its predecessors. Their vision paid off. After making several improvements to the mine, the demand for high-grade iron ore is soaring.
There are two main reasons why this material is so attractive in the world today. One, there's not that many projects that can actually produce high grade in the world. Second, the steel business is working to be able to reduce their CO2 footprint. And by transforming high grade iron ore into steel, they can actually lower their CO2 emission per ton of steel produced.
So there you have it. Betting on the jockey is a solid theme. I mean, if the guy or gal has done it before, odds are just more likely they'll be able to do it again. I'll just repeat, success leaves clues. So that typically spells a win for shareholders. So that's the first half of my presentation. The second half of my talk, I'd like to introduce you to a colleague who's been a regular guest on BTV over the years. Don't let his youthful persona fool you. Ryan Irvine heads up Keystone Financial, a private firm that specializes in analyzing small cap stocks in both Canada and the US, and then identifies them for their subscribers. So I've learned a ton from this fellow, and I look forward to sharing his insight with you. And let's see if we can get him on here. Woo! Hi, Ryan. Oh, can't hear you yet. Just a sec. Are you still on mute? Oh, no, I saw you, but I didn't hear you. Yep, ready for you. I don't think he could hear my presentation ending before. I see he's trying to come on. Configuring settings. Oh. We'll give him another minute here.
I'll come on just in case.
Hi, Brandon.
I want you to be there by yourself while he's going back and forth coming on.
Thank you. I know that we tried it in the technical session earlier, and he was on.
Yeah, I was joking with one of our previous presenters. There's little audio goblins. What I'm going to recommend, Ryan, if you don't mind just refreshing the whole page, we'll come back in. But Taylor, I appreciate that. And you're so right with everything that you're saying, in the sense that if someone has done it in the past, there's a very good chance that they'll continue to do it in the future. They have the understanding. They've been through the grinder and understand what it takes to succeed. And you just showed multiple times that that's exactly what happened.
Yeah. No, it's good examples because, and I have seen it before too. Like, for example, that Midway Gold project, I mean, that there was $100 million spent on that mine, and they couldn't make a go of it. And this guy bought that asset for $5 million. And I know he'll make a go of it because he did it before with Belradian, right? And I just know that he will. He knows the right people, he's the right person, and so on. And so that's just a super good theme. Now I got Ryan on here.
Good. Can you hear me? Can you hear me?
I hear you, and I see
That's a
you.
good thing. I was on, and I came back. I'm back.
That's okay.
There's a bathroom break. No, I'm kidding.
I just kept your seat warm. That's all.
Awesome.
Thanks, Brandon.
Good. Thank you very much.
All right, Ryan. So maybe we'll start off. I gave a bit of an intro to what it is that you do, but maybe share with the viewers a little bit more about your guys, the research that you guys do at Keystone.
Yes, I'm going to say that my name is Ryan Irvine. Apparently, I'm Taylor on here. It says, but my name is actually Ryan Irvine for the record. Although I love the name Taylor too. But what do? We are independent equity analysts. Clients use our services, our recommendations on individual stocks to help them build 15 to 25 stock portfolios. Very simply, we give them buy, sell, and hold advice through reports. They log on to our website, become a client, subscribe to our service, log into our dashboard, and get those buy, sell, and hold reports on a weekly and monthly basis. So a very simple service. We don't take your money. You use a low-cost discount brokerage. You get the buy, sell, hold advice from us. We're completely independent. Our only loyalty is to our clients, and we've been in business now for over 20 years doing the same thing and have a track record that shows that we might know a little about investing in good, solid small caps and good, solid dividend and earnings companies.
Thank you. And I can attest to that. We've had him on the show at least over the last decade, and with his picks, with his small cap picks, and he's had some tremendous wins for our viewers. And so that's why I wanted to have him on. Well, let's get started, Ryan. Why don't we start off with some of the mistakes that perhaps early stage investors make, because you get them in on your platform, and you get them emailing. Like, what are some of the things that you can share with us today? So that
we've been doing radio shows and conferences across the country for decades now. And we talk to tons of investors, and there are common mistakes that are made, particularly by newer investors, early stage. They lack experience. They may predispose them to certain types of mistakes. Speaking generally, they tend to seem to look for a quick solution and, toward their goal towards financial freedom. So they often feel like, number one, my point would be they feel they need to be going for sexy or the hottest stock of the day to get great returns for their portfolio. Yeah. We are here to tell you that you do not have to do that. I'm going to ask you a question, Taylor. I'm going to flip it around on you. Do you know the best performing stock in Canada over the past decade?
The best performing?
Yeah, the best return. If you would have bet on one stock in Canada over the past decade, what would have given you the best return? I gave a speech on this at the Financial Forum when we were allowed to do that back prior to COVID. There was 500, 600 people in the room. Crickets. I heard Canopy Growth was one at that time, but just take a stab at it.
Shopify.
It's a good guess. But it's actually the Boyd Group, which couldn't be a more boring stock. All they do is fix automobiles. So if I was up on a panel and it was a pick the hottest sector 10 years ago, nobody would have said, well, it's obviously auto repair shops. You're never going to hear that that is the company. It returned 9,000%, over 9,000% since we recommended it in 2008 at $2.30. It was trading at $2.30. Today it trades about $215. It's paid us back $4 in dividends. Again, all they do is fix cars. Couldn't be more unsexy, boring business, the best investment to be in over the past decade. So there is the juxtaposition. Sometimes you want the sexy, but sometimes the meat and potatoes, the boring businesses are a great place to be. Number two, I'd say that investors, they try to act like traders. And I don't really blame them for this. If you log on to social media today, if you're interested in stocks, if you've ever logged on to a stock related website, you will be bombarded with some middle to young person, a trader in a fancy car or, a fancy house. And they will be telling you you're just two clicks away from making thousands or $1 million every week. And it's just really so easy for you to do that. I would say it's absolutely BS. While trading or buying and selling stock, trading is essentially buying and selling stocks on a daily basis, an hourly or minute by minute basis. It can look sexy. The proof is in the results. If you look at the data, because the data doesn't lie. I'll quote a study here. It was published just this last year. It looked at traders between 2013, 2015 in the Brazilian equities future markets, which is one of the third largest liquidity markets in the world. So a good market to study. The study concluded, I'm going to quote here, it is virtually impossible for individuals to day trade for a living. Contrary to what the course providers claim, we find that 97% of all individuals who persisted or day traded for more than 300 days lost money. Only 1.1% earned more than the Brazilian minimum wage, and 0.5% earned more than the initial salary of a bank teller. So all of that with greater risk than the general market. So that tells you from the data, day trading is not easy, and it is very difficult even for the pros to make a living there. So the other point that can I go for another point, or do you want to ask me?
I was going to say that's Brazil.
Right?
What about day trading? I know he does this, people. What about day trading in Canada? That's Brazil.
Yeah, and there's similar studies in Canada as well that go on. There's one back in 2000, one in 2009. I could go through 3, 4, 5 different studies that come to that same conclusion. I picked one that is more recent because if I don't, then people say, well, that was 2000, that was 2009. The studies that have went through that average investors that try to day trade, they do not only do they underperform or not make money, they underperform significantly with a higher level of risk. So it's not the place to be for us. And based on the data is what I like to look at. So another thing we see them doing, number 3, would be buying a stock symbol rather than the business. I can't tell you how many times investors have come up to me and said, I bought stock ABC. I don't know what the hell they do, but can you tell me if I made a good investment? Well, what I can tell them typically is you should know, or at least have someone in your corner who knows what the business does before you take any of your hard-earned dollars and invest into that business. Make every stock you invest in as if you were planning to own it as a business. Look at it, look at the balance sheet, look at the cash flow, look at the growth prospects, the valuations, as if you were going to own that business. If you were going to buy a pizza shop tomorrow, you had $200,000, you inherited it, or you made a bunch of money and you had $200,000, you're going to buy a pizza shop. You wouldn't go in and just say, well, I love the color of the business or the name, I'm going to buy that business. You would look at the cash flow, the balance sheet. You want to look at the bank statement. Is there a ton of debt there? Is there cash flow coming in? Is it in a neighborhood that's growing, so there's growth around it? So look at a stock that way, and it'll serve you well over the long term.
And I'll add to that, well, because, this is really just, I'm going to add to that. No, but I know that you guys actually call the CEOs of companies that you're looking at. Like,
oh yeah, all the time. I mean, we wouldn't. You want to get it straight from the horse's mouth. Talk to the intellectual capital behind the business that you're investing in all the time.
All right.
So can I go point number 4 and then we'll move? I got a lot of mistakes out there that I see on a constant basis. This is the last one I'll give you. And we get to get Warren Buffett in here. So they confuse the price of a stock with value. Some of the cheapest stocks on the market trade well above $100 and even $1,000 per share. And some of the most expensive, what we call not the best companies out there, can be had for under $1. So Warren Buffett always says, price is what you pay, value is what you get. There are plenty of garbage stocks trading at 80 cents or 40 cents. And there are plenty of great businesses trading at $100, $200, $300. So don't just look at the price, look at the value in the business they're getting. We find many great businesses that are also trading under $1. We just have to look at that underlying business as well.
Okay, so excellent advice as always. See, this is the difference, folks. When I have them on the show, my editors, they cut them. How do you recommend?
Can't cut me live. It's terrible.
It's like, what's happening? Is the train just going? How do you recommend investors start building or fixing their existing portfolios today? Then, based on
great question.
All right.
Great question. I start by reading. Take control of your portfolio. Read all you can and learn about investing generally. I would say get a simple discount brokerage account. Start building your own portfolio today. There are 2 things. If you want to look at buying individual stocks or low-cost ETFs, it depends on your goals and risk tolerance levels. But if your goal is to mirror the market, just buy low-cost ETFs. You could buy 3 of them. Essentially buy a low-cost Canadian index ETF, buy a low-cost US ETF, and a low-cost international market ETF. Put 33%, 33%, 33%, and get up to about 100% there. It's a low-cost shoestring budget portfolio. You don't even need to pay a robo-advisor to put you in a fund, those 3 funds. You'll save money. You won't pay 0.5%. You'll pay 0.1 or 0.2% in that range, which can, if you want to mirror the markets, if that's your goal, that's great. If you want to beat the markets, create your own simple equity fund. Make sure you're in quality cash positive businesses, dividend growth stocks, and just really great quality business. And we'd say your goal is to build a 15 to 25 stock portfolio. Build it over 12 to 24 months.
So why
there?
I know that that is one thing that you have said to me before, just 15 to 25. And tell people that are listening in on that are still with us at the end of the day, why that number? Like, we're the last speakers today. There might not be anybody left on here.
There's probably nobody. I'm talking into a dead mic. It's like our podcast. Actually, we listen into our podcast. We're getting thousands of listeners now, but it's great. Anyways,
why only 15?
Why?
Only 5? Yeah.
Great question. And keep in mind, most mutual funds have 100 plus stocks in them. So why are we suggesting 15 to 25? Well, if you look at modern portfolio theory, you come close to optimal diversification, which most people are trying to achieve with just under 20 stocks in your portfolio. So why would we need to own 50 or 100 or, larger than 20 stocks in your portfolio? Quality businesses are, diversification will make sense to a point. Generally, you don't want to buy 2 to 3 stocks. Even if you put all the research in the world into those companies, it's too much company-specific risk. An extreme example of that would be if you look at Elon Musk, the CEO of Tesla. If he were to pass away, for example, that's your company-specific risk. You cannot mitigate that if it's one of 2 or 3 companies in your portfolio. If it's one of 20, you can handle that company-specific risk. So you don't want 50 to 100 either, because then you are the market and you mirror it, the return, but you pay more fees doing it that way. So that's 15 to 20 is the sweet spot.
So, okay, that's a sweet spot. And what about for you with respect to sectors? Are you liking a sector? Are you diversifying within sectors?
We do a lot of sector specific reports. We did a cannabis sector report. We've done that for 3 years now. We did, and it was hard to find value there. We recommended one company, but we're really sector agnostic. We're slaves to cash flow for the most part. Our research leads us to the sectors where we think we can find the best shareholder return. If we want to say, we've been invested in some renewable energy companies for the past 3 to 5 years. It's been a great sector. We think that segment has tailwinds behind it going forward. We still love great technology businesses with recurring revenue bases and have been invested in those for years. More difficult in Canada, limited area that we can look into in terms of companies, many in the US that we can buy there as well.
So what about, okay, let's hear it, Ryan. What about some of your picks, buddy? Give us a couple of your picks and why, and just to share with our viewers here today.
Okay, in the renewable theme, we'll keep it in there. Polaris Infrastructure, PIF, is the symbol on the TSX.
You've liked them for a long time.
About a year and a half, and for us, that's still short term. I mean, we like Boyd for the past 12 years, right? But yeah, why do we like it? It's in the renewable power sector. It is Canadian based, but really in Latin America. Currently, it operates a 72 megawatt facility located in Nicaragua, 3 run-of-river power operations in Peru, and they've moved into Panama. So they're diversifying throughout Latin America. They have a great balance sheet. Net debt to EBITDA is 2.0. The payout ratio, so their dividend is 5.8%, almost 6%, and their payout ratio is only 20% of cash flow, so low for that segment, allows them to up it over time, which we expect. And it is geopolitically more risky than many in the sector, but it trades at about 4 times operating cash flow right now, which is very low. It's too much of a discount. We think the fair value is around $20, so you're buying it right now at $13.50. 40-50% upside from here, and you're paying getting paid a 6% dividend. Growth at a reasonable price. We like that.
And your second pick? Let's hear it.
We're going to look at, you're talking a lot of mining stocks, so we generally, I don't comment too much on them. We like cash flow. It's hard to get into that with some of those consistent cash flow, but Dynacor is about 185. It is a miller, not a miner. Purchases ore from local government registered artisanal miners or small scale miners in Peru. They closed down facilities March 16th because of the COVID pandemic, and now they brought it back online. We expect by the end of last month, they should report this soon. They've brought their mill back up to 300 tons per day, which is capacity. They should go beyond that. 20 million US in cash in the bank, virtually no debt, trades at 4 to 5 times normalized cash flow, pays a 3.2% dividend. There's growth, and we expect they should surprise in the fourth quarter, which should come out sometime into early next year. You're buying it at a discount right now, growth at a reasonable price. We like that type of story.
Awesome. And give us one more. So we get.
Well, I mean, if I was here, just about a week ago, we would have recommended H2o. HEO is the symbol. H2o Innovations. Yeah. We love it. We love the water space. It's water purification, sanitization. It's a great space to be in. The stock has moved up about 70% in the past month. Yeah. So right now we've got it at a hold. We think it trades at around 12 to 13 times enterprise value to EBITDA. So it's trading in a normalized range that we like right now. If you're looking 3 to 5 years out, we think HEO will continue to make good acquisitions, and we think it'll grow its cash flow, which you need to do to grow the business over the long term. There we go. Well, that ends it off. What I'm going to say is if you want more information on Keystone Financial, you can just go to www.keystocks.com. Sign up, subscribe to our podcast every week, send your questions into our Ask Us Anything or Your Stock, Our Take. We'll answer any questions on any stock in Canada. We have no lives. We look through 3,000 companies twice a year on an annual basis. So send those questions in. Thank you very much. Thanks for having us, guys.
Yeah, and thank you for all this. And yeah, you were right earlier. Been a very long day from 10 a.m. till 5 p.m. This is the 8th webinar of the day, but a very fascinating one. I appreciate the time that both of you have taken to be on here. This is recorded, so a lot of people are going to be able to watch this after the fact as well. Get those 3 picks, but also hear about going with the jockey, put your bets in the jockey, and also for yourself as well, Ryan. Not Taylor, Ryan, and all the stuff you were going through this. So I loved it. Thanks you very much, everyone.
Thanks for having us.
Take care.